Picture this. You're in your 50s, relaxing on a beach, sipping a cold drink, and checking your investment portfolio. It's grown to 6 or even 7 figures. How? Because in your 30s, you made the smart choice to start investing. Many people delay investing, thinking they need a lot of money or expert knowledge. The truth is, you can start small and build wealth over time with simple strategies. But what are those strategies that can make you financially free by the time you're 50 if you start investing in your 30s? This video covers 8 step-by-step strategies, a sample portfolio for you, a bonus point in the end, and, most importantly, the mistakes that beginner investors like you often make. Mistakes that can wipe out all your investments if ignored. So, make sure to watch till the end. Strategy number 1. Build a strong financial foundation. Before jumping into the stock market, you need a solid financial base. Life is unpredictable. Job loss, medical emergencies, or unexpected expenses can happen anytime. To avoid derailing your investments, you should have an emergency fund with 3 to 6 months worth of expenses in a high-yield savings account. If your monthly expenses are $3,000, aim for at least $9,000 in savings before heavily investing. Additionally, high-interest debt, such as credit cards or personal loans with 10% plus interest rates, should be prioritized and paid off. Investing is great, but if you have high-interest debt, the returns you gain from investing will likely be wiped out by the interest you owe. Think of it this way. The stock market historically returns about 7 to 10% annually, but paying off a 20% credit card balance gives you a guaranteed return on your money. Protecting yourself with the right insurance is another key step before investing. Health insurance prevents massive medical bills. Disability insurance ensures you have an income if you are unable to work. And term life insurance is a must if you have dependents who rely on your income. With these safeguards in place, you can confidently begin your investment journey. 2. Maximize your retirement savings. Your 30s are the perfect time to supercharge your retirement savings. The earlier you start, the more time compound interest works for you. If your employer offers a 401k, take advantage of it, especially if they offer a match. For example, if your company matches up to 5% of your salary, contribute at least that amount. It's essentially free money. Within your 401k, choose low-cost index funds for long-term growth. If you want to go beyond a 401k, consider opening an individual retirement account, IRA. A Roth IRA is particularly beneficial if you expect higher taxes in the future since your money grows tax-free. A traditional IRA, on the other hand, allows you to deduct contributions from your taxable income today. As of 2025, you can contribute up to $7,000 per year to an IRA if you are under 50. If you have a high-deductible health plan, you can also invest in a health savings account, HSA, which offers a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. 3. Invest in low-cost, diversified funds. Investing doesn't have to be complicated. Stick to low-cost index funds and ETFs for broad market exposure and lower risk. Instead of trying to pick individual stocks, you can invest in broad market ETFs such as VTI, which gives you exposure to the entire US stock market. If you want to diversify further, VIXUS allows you to invest in international markets. For those who want a more hands-off approach, target date funds automatically adjust your investments as you get closer to retirement. A good starting allocation in your 30s is 80% stocks for growth and 20% bonds for stability, but you can adjust based on your risk tolerance. 4. The power of consistent investing. Investing consistently is key to building long-term wealth. One of the best ways to do this is through dollar cost averaging, DCA, where you invest a fixed amount every month, regardless of market conditions. For example, instead of investing $6,000 all at once, invest $500 per month for a year. This strategy smooths out market ups and downs and reduces the impact of market volatility. Automating your investments by setting up automatic transfers to your 401k, IRA or brokerage account removes emotion from investing and keeps you consistent. 5. Optimize for tax efficiency. Tax efficiency is an important aspect of investing. Tax-advantaged accounts like a Roth IRA allow your investments to grow tax-free, while taxable brokerage accounts should be used once you've maxed out your retirement accounts. Within taxable accounts, choosing tax-efficient ETFs and using strategies like tax loss harvesting, selling underperforming stocks to offset taxable gains, can help you keep more of your returns. 6. Explore additional investment options. Beyond stocks and bonds, you may want to explore additional investment avenues. Real estate can be a great way to diversify your portfolio. If you don't want to manage properties, real estate investment trusts, REITs, such as VNQ, provide exposure to real estate without the hassle of being a landlord. If you're willing to take on more risk, individual stocks and cryptocurrency can be an option, but these should be limited to less than 5% of your total portfolio. 7. Stay educated and avoid common mistakes. As you continue on your investment journey, staying educated and maintaining good financial habits is crucial. Reading books like The Simple Path to Wealth by J.L. Collins and The Boglehead's Guide to Investing can provide valuable insights. One of the biggest mistakes investors make is trying to time the market instead of waiting for the perfect time to invest. Remember that time in the market is far more important than timing the market. Rebalancing your portfolio once a year and increasing your contributions as your salary grows will help keep you on track. 8. Beware of high fees and emotional investing. A common mistake many investors make is paying high fees. Expense ratios above 0.5% can eat away at your returns over time, so it's best to stick to low-cost providers like Vanguard, Fidelity, or Charles Schwab. Emotional decision-making, especially during market downturns, is another pitfall. When the market drops, it can be tempting to panic sell, but staying invested and following your long-term plan is key to success. So, based on the above strategies, what should a well-diversified portfolio for a 35-year-old might look? Here's a sample for you. 70% in U.S. stocks through VTI, 15% in international stocks through VXUS, 10% in bonds through BND, 5% in real estate via VNQ. This balance provides exposure to different asset classes while maintaining growth potential. However, this is just an example. Create your own customized portfolio. Bonus point. Here are some tools that can simplify your investing. If you prefer a hands-off approach, robo-advisors like Betterment or Wealthfront can manage your investments for a low fee. For those who want to handle their own investments, brokerages like Vanguard, Fidelity, or Charles Schwab offer excellent low-cost options. Take action. Today, you don't need thousands of dollars to begin investing, just the willingness to start. Even investing $100 per month can snowball into significant wealth over time thanks to compound interest. The key is to start as early as possible, be consistent, and keep your investment strategy simple. Want to learn the secrets of the world's greatest investor? Watch my video, 6 Golden Rules of Investment by Warren Buffett, and take control of your financial future today.